Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Sunday for Sunday, March 28th, 2021. I'll be joined today by members of the media, academia, and financial services as we analyze all the news this week in retirement, markets, technology, personal finance, so much more. So sit back, relax, and enjoy this episode of BRN Sunday. We're going to kick things off with a look at retirement. Joining us on the line, she is the retirement reporter for Market Watch. You can check out her writings each and every week. I don't know if she does it on a daily basis, but she writes quite a bit. Very passionate about the topic. Let's welcome back to the program Alessandra Melito. Allie, great to talk to you. As always, thanks for joining us this morning.
Yeah, of course. Nice to be here.
And just correct me if I was wrong. Are you putting out new pieces every day? Because I know you have multiple columns going at the same time.
Almost every day. Yeah, I have the column Help Me Retire, which looks at reader questions about their personal situations, and then also retirement hacks, which is like the actionable piece of advice for somebody who wants to maximize their retirement savings. But then I do my daily stories still.
Yeah,
So pretty much every day.
Yeah, so you're out at the computer. I'm assuming you're not writing on a notepad like in the old days, but and you're not at a typewriter at the computer on a regular basis. So, Allie, what's top of mind this week? I know you wrote several interesting pieces.
Yeah, so this week, one of the stories that I really enjoyed writing was about how older Americans are spending their stimulus checks. Because, as you know, retirees, for the most part, they are on a fixed income, and this 1,400 check is pretty helpful for those folks. So I just talked with a few people across the country about what their plans were for that money, and it was a really nice piece.
So where, theoretically, older Americans, those that are retired, are drawing from Social Security. Maybe they have a 401k or a pension plan. Maybe they're lucky enough, Allie, to have a pension plan. Where are they spending their stimulus checks?
Yeah, so out of the people that I had spoken to, they said for the most part, for right now, they're going to hold on to the money.
Mm-hmm.
Because even though they might be drawing down Social Security or have some additional savings or a pension or anything like that, this money is very helpful to make sure that they have that sense of security. A lot of retirees, like I said, they are living on a fixed income, and they might be very careful about every dollar that they spend, even if they have, some pool of money in a savings account or an investment account or whatever. They still want that, sense of comfort that they're able to weather any potential storm. And as we know, in retirement, anything is possible, especially with rising costs of healthcare and just living in general. So some people that I spoke to said that they're saving this money, that they're going to use it to pay their bills and stash the rest of it in an account and see what they want to do from there. And other people have really fun plans. So nobody that I spoke with was ready to start traveling yet. They still want to hold off on that,
Mm-hmm.
but they are making plans for travel. One person is going to stay very local. She was thinking about just going to like a nearby state park with the lakes, but somebody else said that she and her husband are planning a trip back to their hometown, a few states away, so that they could see family and friends. And then one person that I spoke to, she was really fun. She said that she is planning to earmark a portion of her stimulus check towards learning how to use Instagram better, because she's new to the iPhone and she fell in love with the camera capability. So she's a former journalist, and she is using the camera to take pictures and do like little interviews here and there, kind of like Humans of New York, I guess.
Mm-hmm.
And she is going to take some money to spend on lessons to get better with the Instagram stories and reels.
Oh, interesting. Let me ask you, Allie. I mean, just going through this pandemic, and I've been reading a lot in your column and elsewhere about this is the right time to bolster your emergency savings. And I have to think that if you are on a fixed budget, retiree, or just a fixed budget in general, this pandemic really might reshape your thinking about what you need to have both short term and long term should we undergo something like this again, right? I mean, it's really, and whether you are a younger person like you are, or middle aged like I am, or a mature person, that this is really having a profound effect on what people think they will need, um, both during and before retirement.
Yeah, I mean, I think the pandemic has definitely exemplified the importance of an emergency fund. Just for even so many, so many potential unexpected scenarios.
Hmm.
I mean, for some people, it was a matter of health. They got sick and they needed that money to help pay the bills. Other people, it was a loss of income, either because they lost their job or they had to they had to move to part-time because of everything that was going on. And, there's so many other things that the pandemic has brought about that people might have never even fathomed possible. So I think the last year has really shown people just how important it is to have that cushion to fall back on,
Hmm.
definitely in the short term for those health expenses or, living expenses, but also to feel comfortable. And I think that's kind of like why we see we see so much interest in stories around FIRE, that financial independence, retire early, because those people, they are, for some of them, it's not even a matter of retiring early or not having any income. It's just a matter of feeling financially independent, where if something were to go wrong or they just decided one day, I hate my job and I don't want to be here anymore, that they could leave and that they would be able to, sustain any financial hits. So, yeah, I agree with you. I think that for everything that we've seen in the last year, it has absolutely been a lesson in saving and investing properly and just, trying to maintain some sort of financial stability.
Yeah, and to that end, I mean, you're seeing people, not you particularly, but in general, we're seeing people that want to hold on to their jobs longer. They don't want to retire at age 65. Maybe they want to keep working in some capacity because, once you give up that job, sometimes it's very hard to come back out of retirement, and work. So maybe having that job or reducing hours, but still having that pay and getting some level of benefit, whether it's access to the retirement plan or access to health care, that seems to be on the minds of a lot of these pre-retirees too.
Yeah, for sure.
Yeah, well, Ali, really appreciate you coming on the program. Really great stories this week, and we enjoy your company and your analysis. Have a great rest of the weekend, and we will talk to you again very soon. Welcome back. Now, time to talk tech. Joining us on the line, returning from a recent trip, is Daniel Klein. He's lead advisor, executive producer for Seven Investing. Dan, always a pleasure talking with you. Thanks so much for joining us on the program this morning.
Jeff, a little bit of recovering. Not so much the trip, but it's been so long since I've had a time change, and it's been so long since I've sat in a plane. My trip to Las Vegas was no plane change, but made a stop. So I was 7.5 hours in my seat. That is a long time for any person to be sitting anywhere.
Yeah, that seems actually like like torture. And I wasn't implying when I say recover, I didn't mean anything regarding consumption of beverages. I was strictly
There might have been a little sampling of beverages.
okay. Well, I wasn't presupposing anything. So Dan, lots going on in the tech world, even while you were in Las Vegas. I know Disney Plus decided it's going to raise its prices, and it's a very successful streaming platform.
Yeah, so they announced this a while back, but it takes effect this week for new subscribers, and there's some sort of grandfather deal for existing subscribers. It doesn't necessarily kick in immediately for you. It depends how you subscribe. They're going up $1, so they're going up from $6.99 to $7.99. Jeff, if they went up to $12.99, I'd have no issue with it. The thing I most look forward to almost every week is what is the new release going to be on Disney Plus on Friday. Right now, it's Falcon and the Winter Soldier. I watched episode 1; it was excellent. Previously, it was WandaVision, which was also good. They have other content. They put out a new Mighty Ducks, but basically every week they have appointment viewing content, and It still costs dramatically less than Netflix. They don't have the depth of a Netflix unless you're a kid, where there's obviously a huge archive of children's programming. But I think Disney is doing this absolutely right. And when you look at their subscriber base, and it's not all in the U.S., but let's say there's roughly 70 million U.S. subscribers. I don't think they actually break down the number. Every dollar they go up, that is $840 million a year. So this price increase is meaningful to the bottom line. And this is just a U.S. and Canada price increase. It doesn't affect the rest of the world, and that's largely because they were slow to roll out, and it's not as established a service elsewhere. But this is a company that's on their way to 300 million subscribers, probably by the end of next year. It is a smashing success.
Yeah, I mean, we've talked about this before. I mean, everyone grew up on Disney. I mean, I grew up on Disney. You grew up on Disney. The kids today grew up on Disney. But it's all the associated brands with Disney. The Obi-Wan Kenobi show, which is going to be new. I mean, how many Star Wars shows are they going to have, Dan? They already have Mandalorian.
Yeah,
How many are they
so
going to have?
they have something like, I want to say, 11 Star Wars shows, including a Mandalorian spin-off about Boba Fett. So hopefully they can maintain the quality. The thing about The Mandalorian is Jon Favreau is leading it. He is a top tier, movie director,
Yep.
and they've done a good job at bringing in top talent behind the scenes. They need to keep that up. Now, there's a cartoon coming out, spin-off sort of the Clone Wars, and I don't expect the cartoons to live up necessarily to the adult standard of the live action shows, but everything I've watched so far, and admittedly, that's only those two shows I just talked about, on Disney Plus, has felt to me like an incredible value. Whereas, Netflix puts out a lot of garbage. Netflix has very much a hire a bunch of people, let them throw stuff at the wall and see what sticks. And to me, I kind of want there to be a limited amount of stuff that I have to watch. It's hard enough for me to get through, sometimes an episode of a show before the weekend because I don't want to get to work on Monday, or virtual work such as it is at the moment, and have somebody talk about Falcon and the Winter Soldier, and I haven't seen the episode yet.
Yeah, that would ruin it for you, Dan, and then you would be it would send you into a deep depression. Dan, let's talk about I'm just saying that tongue in cheek, of course, and not making light of mental illness, because obviously that is a very important topic that we can discuss in a later date on the program, and we will. Dan, let's talk about a recent report from Harvard that work from home is more appealing than a return to business as usual. I mean, like, no duh, right? I mean, we all want to see our friends, but working from home has got some pretty good perks to it.
Yeah, so here's the thing. I would like to think that companies have learned a lot. And by that, I mean, I don't expect most companies are going to go back to 100% in the office. I think even the strictest companies that want to have people in the office are going to be much more tolerant of, hey, I don't feel that well today. I can still make the meeting, but I'm going to work from home. Or, hey, my kid has the flu and I can work all day, but I need to be here, or whatever. I'm getting a refrigerator delivered. I think even the strictest companies are going to allow that. But I think the vast majority of companies are going to offer either some sort of hybrid work where, hey, we'd like everyone in the office on Wednesdays, and then you can pick one other day a week, to be there, or you can come in full time, whatever you like. And I think some companies are going to have much more of a choice. Like, do you want to work remotely? Well, here's the consequences of that. You might not be able to get certain promotions. You might not be eligible for certain jobs. There are certain things that are more conducive, to being in the office. So look, I think we learned a lot. I've worked from home for the past 7 years roughly, and I am very, very, very productive. And being at home gives me all the time I would have been commuting to do other things like work out, and often it ends up in me just working more. So of course people are happy with this. I have a number of friends who have moved farther from their offices because they intend to not go back full time. I know a few people that have made job decisions based on what their companies were allowing and what they planned to go back. I have a friend who changed jobs because he wanted to continue to live in Hawaii and not have to move back to the expensive west coast of the U.S. So I think this is all very, very encouraging.
Now, Dan, what does this mean? I would think that whether you work for a corporation, and it's going to vary, right? You're going to have different policies depending on how big a company is and what your functional role is. But what does this mean for culture? The importance of a culture at a company, that's a lot. I mean, that it's hard to maintain through virtual connection.
Yeah, it's a big problem. So, I work for a company that at our biggest has about 10 people, a handful part-timers and 7 or 8 full-timers. And even then, it's difficult to build a culture when you don't have the ability to be in person. I think when we have the ability to do a couple of in-persons a year, you can build some culture. But no, I look at where I used to work at the Motley Fool, which I spent a couple of days a month in the office, and the office set the tone for the company. It was a collaborative office with big open spaces, lots of fun events, lots of clubs, lots of you could go take a yoga class, or you could be part of the horror movie club, or whatever it is. There was a very vibrant and active office life. And I do think for some people that's never going to return. And you might not feel as connected to your company if you work remotely. Like, the thing you don't want is, if you're a great company that people really love working at, you don't want a portion of your workforce to become transactional. And that is something, how do you maintain that feeling of togetherness when you're not together? And some things like Zoom and Slack are lacking for building, especially at big organizations, at building that sort of camaraderie and company culture. And look, when I was at my previous company, I could walk down the hall and bump into the CEO and talk for 10 minutes and say something out loud that might raise my standing in the company or lower my standing in the company. That's not as easy in a virtual world.
Yeah, what does it mean? What I took away from the study is, number one, if you live in a big city, you don't want to have to commute. You don't want to have to commute if you live in New York. Take the train down, take the 7 train down. Maybe you're on there for 30, 40 minutes, packed in with people. You may not want to drive in. I mean, it really is convenient to be able to literally roll out of bed. You don't even need to wear pants. You can just wear a nice shirt. Maybe you can just wear shorts, right? So there's something to be said about that. And maybe this has given people an opportunity to say, look, I don't want to travel into the office, and I also don't want to travel for work. I don't want to jump on a plane. I don't want to sleep in a hotel every night, 5 days a week or 4 days a week visiting clients. I don't want to do it. So maybe people have just rethought things.
Here's the thing. I think it's going to be a mixed bag. So a lot of my friends who live in a city have very, very little space. I have one friend and former colleague that lives in a 1-bedroom with a pretty large dog, his fiance, and I believe she's back in school, but for a while she was teaching from home and he was trying to work from home. That's really, really difficult. My wife and I were in a 1,300 square foot condo, where my son was home dealing with school, and we were both trying to work in a very, very small space with, only so much internet connection going around. So I do think there's a subset of city dwellers who are eager to have the office as an option, even if it's just so they can occasionally spread out. Look, I think most of us are going to be in the office less. Those of us who went to an office are going to be in the office less. And people like me and you who moved to have more space during the pandemic, I think it's going to be a long time before we want to go back to a smaller space. Like, look, would I like to go back to living downtown when this is over, when I can safely walk to all sorts of restaurants? Yeah. But am I necessarily going to want to give up the fact that I have 1,000 square feet more and a garage and a nicer gym and a giant pool? Like, I'm not necessarily going to want to give those things up. So there are shifts, but I don't think there's this universal, I never want to go back to the office feel.
Yeah, I agree. I think they'll do it in like stages, like 2 days on, 2 days off, kind of thing. I think that'll be staged until this thing has kind of resolved itself, whatever the new normal looks like. Dan, always pleasure chatting with you. Disney Plus and the Harvard study. What a dichotomy of views this week. Have a great rest of the week, and we'll talk to you again very soon.
I'll see you next week, Jeff.
Bye, Dan. Welcome back. Now time to talk. Mark is joining us on the line. He is the lead anchor for the TD Ameritrade Network. You can see him Morning Trade Live and Markets on Close. I'm talking about Oliver Rennick. Oliver, great to talk to you as always. Thanks for joining us again.
Hey, Jeff. Thank you. Appreciate it.
Happy Friday and happy weekend to you, and happy weekend. I should say happy weekend to all of our great listeners and your viewers out there. So Oliver, the question I always ask you is, what are the key themes for the week when you take a look at markets?
This has been a very interesting week. We continue to basically have this battle playing out between two sides of the market. As we discussed last time, a good bit of just kind of real uncertainty about kind of who's in control of the market right now, bulls, bears. and we're not really left with a lot of answers. We're kind of hanging on a thread into the weekend. Basically, what we've got is a market that has had some weakness, and that weakness began with interest rate sensitivity by tech companies. And over the last 5 days, that turned into, or rather, maybe not turned into, but was accompanied by more kind of economic-driven weakness and fundamental concerns about the recovery stemming from a slowdown in the rollout of vaccines through the AstraZeneca vaccine in Europe, and then some flare-ups of the virus through a few stories here in the U.S., and that led to a whole different part of the market softening up and selling off. That's small caps, the Russell 2000, cyclical companies, reopened trades, basically. So what we got is a taste of weakness in those reopened themes that you could tie to this kind of hiccup that we had in some of the reopening narrative. But there's also just the notion that a month ago, the stock market was trading at valuation levels higher than .com, had record sentiment and participation by just about every measure you can imagine, and that we really don't need any reason for things to sell off. Tech has been the first culprit to drop with the rise in interest rates that has caused people to kind of second guess and retool what they want to pay for companies. But if you look at the way we've had these huge rallies in reopening stocks, a lot of them also now are at a place that is pretty easy, that is hard to justify, easy to argue against. Companies like Gap, L Brands, that are trading way above where they were pre-COVID. And obviously we're not back to pre-COVID life. Macy's, as of last week, was trading above pre-COVID levels, and this week sell-off brought it back down. So I think that kind of embodies the overall kind of need for some kind of, return to, reason to some extent in a market that's gotten really, really frothy and elevated. So how much of that froth needs to come off is really the big question, and nobody knows that because, you can't time these things. You can't time these things, and bull markets can be irrational, and they often have a habit of keep going beyond anyone's expectations. So we're kind of just watching technicals to try and figure out if there is a real sustainable rollover or if this is just a one-time pause as we process this new environment.
Follow-up question, Oliver, with regards to, I know we saw a increase in the GDP for the fourth quarter 2020. I think they revised it up slightly. But what about jobs numbers? Have you seen job claims? I think we've seen job claims go down as of recently. If I'm not, jobless claims, I think, go down. So I guess, what's your take on some of the revisions, and will that have an impact? Could that have an impact on market sentiment?
Yeah, for sure. We had a pretty good jobless claims this week, best that we've had. First over under 700,000. GDP is starting to build some momentum, and manufacturing numbers still look good. So the overall message about recovery is very real, supported by the data, but complex for the markets, given that it also means we should expect yields to keep climbing pretty much until we're given some other reason to think so. The bond market did find some buyers and yields dropped as the equity market sold off a little bit these past 5 days. But on Friday, we are heading into the weekend with yields moving higher again, despite a softer than expected inflation report. So it just seems like, the evidence here from the chart is pretty clear that the trend is higher in yields. Until that trend changes, there's no reason to think that that's going to change because the data's been good. So there's just no real reason to think that bond yields are suddenly going to turn around, at least in my opinion. There's a lot of people that think they're going to be capped for whatever reason, but I think that's just because people have generally thought of yields as being capped. There's just that requires a real kind of fundamental view and a prediction There's nothing based on recent events that should tell us yields are capped. They just keep going, and the economy seems to be picking up steam. So there's no real reason to think that's going to stop, which means that we also don't really have a lot of reason to think that weakness in the NASDAQ that goes along with those higher yields is going to stop until something tells us otherwise there as well.
Last question, Oliver. Bitcoin, we've been talking about that for several weeks, more than several weeks. So its ascendancy continued to ascend, kind of regressed a little bit this week. What do you make of what's going on with cryptocurrency? That's a big part of the market. A lot of people are talking about it. A lot of people are thinking about it. More retail investors involved in it. So what's your take on what's happening now with, I guess, Bitcoin's the main brand, but there are other brands in crypto as well.
Yeah. Well, it's a $1.6 trillion market. I feel like maybe you saw what I wrote this week with the BTC question, but if not, go check out the newsletter that I write on LinkedIn, and I did write about it this week. I think it's a huge deal. I think Bitcoin certainly has garnered attention over the past year because its potential for a hedge to fiat devaluation has become a little bit more compelling with all the money printing that we've been doing, but because it's still, in my view, is a very low probability that any of this stuff backfires the way Bitcoin needs it to. I mean, we're seeing the dollar firm up after stimulus. We are seeing yields rise as the dollar firms up. The market is telling us that this stimulus is economically positive, and there's no sign of it being hyperinflationary yet. So you have to have a really strong view on how this is going to play out, again, because it's just not in the data yet. So I think the narrative for owning Bitcoin is getting weaker over the past 3 weeks, basically, since we announced this stimulus. And I think that's why Bitcoin hasn't been making new highs post-stimulus. You would think $2 trillion getting approved and injected into the economy, that was supposed to be great for Bitcoin. But it seems pretty clear that was fully priced in. And it was also priced into the dollar because the dollar has been rallying. And that's a very, very big deal because nobody's really thought the dollar was going to rally at any point this year. And now it's making a trend higher. So Bitcoin, to me, at the end of the day, is still a high-risk investment, which means that it is even further along the spectrum of risk-taking than stocks. I view it as basically a barometer of sentiment, that it is basically a roulette wheel. And if it goes down, I think that is a big red flag to stocks and risk assets as a whole, because Bitcoin is a representation of the froth in markets. Bitcoin is the purest reflection of people's willingness to take risk on buying something that has no utility yet beyond what the next guy will pay for it. So, yes, the possibility that its utility will increase did go higher this year, but still not enough to not make it a gamble. And that's why I'm watching it very closely, because it is now slowing its momentum after everything that Bitcoiners wanted to happen came true. Trillions of dollars of stimulus and a Fed that is just begging inflation to arrive and coaxing it. But Bitcoin's not making highs because this has already been priced in. So we need to watch it very carefully.
Yeah, very interesting. It's amazing to watch this up and down. And if you're a technical analyst, I got to think that watching these trends may make you a little batty. Oliver, we're going to have to leave it there. Always great to talk to you. Remember, you can always check out Oliver Rennick on the TD Ameritrade Network, Market on Close, and Morning Trade Live. He anchors both of them. Oliver, have a great rest of the week and weekend. We'll talk to you again very soon.
Thanks, Jeff.
Bye. Welcome back. Now, time to talk real estate. Joining us on the line, he is Market Watch's real estate reporter. Let's welcome to the program Jacob Passy. Jacob, always great to talk to you. Thanks for joining us this morning.
Glad to be here.
So, Jacob, I'm looking out my window now. It's Friday afternoon here in Charlotte, and the weather is fairly nice. It's sunny. I haven't been outside yet, but I know it's kind of getting into the spring, and spring usually means, to me, going out, maybe shopping for homes. Want to check in with you on the latest trends in real estate.
Yeah, well, spring home buying season, I don't know if it really, ever left since last year. We had the weirdness last year with COVID during the normal spring home buying season, but then, crazy volume in the summer, fall winter, and now that we're actually in spring, it's really hitting a fever pitch. So it's definitely a competitive market out there, and people are flooding right into it.
That's great. Well, I guess that's good. That's good, right? I mean, it shows that people are looking for homes. I guess it could make it difficult for first-time home buyers, as I know that you've talked to us about that before.
Yeah, so a good report, or not good per se, but an interesting report, I should say, came out today from Redfin, the national real estate brokerage, and they keep a tab on the market, and they found that 39% of homes were selling for more than their asking price.
Wow.
So that kind of just shows you how competitive it is. Over a third of the homes being sold right now are going for above listing, which is just crazy. I mean, that's a significant share, and it shows how competitive the market is. And then when they broke other data points down, almost half of the homes under contract as of March 21st had accepted an offer within 1 week of being on the market.
Wow.
And over half accepted an offer within 2 weeks of being on the market. So if you're buying a home right now, you've got to basically be prepared for intense competition no matter where you live. This is not, a California thing, a New York thing. This is a national thing. And you need to be prepared to go in above asking, which is difficult. So with that in mind, that probably should shape what homes you're thinking of looking at. I would be careful about looking at a home right now that is at the top end of my budget, given the fact that there's a significant chance there will be competition for it. So it's really tough out there for buyers, and it's not necessarily getting any easier.
Jacob, when you look at, you mentioned that it's not in the typical places that we would think, the Californias and the New Yorks. Where are we talking? Are we talking in I think it was Boise, Idaho? Is that one that you had mentioned before that was really kind of running up the property values? Where are we talking about in the United States?
Yeah, we're talking definitely about Idaho. We're talking about places like Arizona, like the Phoenix area. Colorado's still really popular. And in general, the suburbs and more rural areas are really hot right now. The trend that we saw coming out of the pandemic, in the midst of the pandemic last year, was that people wanted more space because they, might now be working from home more permanently. They might, have a growing family, and living in tighter quarters and in a city perhaps wasn't as desirable as it once was. And also because of the fact that more people can work from home, either permanently or, perhaps a few days of the week. That means that they don't necessarily have to worry about, the kind of mind-numbing commute that you would otherwise have if you lived further out from, the job center in your area. So as you get further and further out of cities, we're seeing a lot of demand in those areas. And then it spreads, some of these kind of secondary markets that are now just attracting people from the pricier coastal markets.
Yeah, I like that you bring up, in the question before this one, you brought up the fact that you should really be thinking about your budget. And if you have to go above what you're going to spend, you need to be aware of what that means, because, we all have fixed budgets. And if you go above what you need to spend to secure a home, how do you furnish it? What about taxation? Things that come maybe on the back end of that you maybe are not thinking about. It's really important, Jacob, I would think, to plan all those things out. What are your moving expenses going to be? Are you going to have a different tax, be in a different tax strata because of it?
Exactly, and it's the down payment. It's all the different parts of it. I have two of my best friends are right now shopping for a home, and in the market where they live, it's pretty common for instance, for buyers to waive the appraisal, and that's a risky move potentially. If you buy a home without an appraisal, there's nothing to say that you're perhaps buying a home that's valued much higher than it should be, and then down the road you might find yourself at more risk if the market sees a downturn, if you try to refinance, things like that. And so but they talked to their real estate agent and kind of figured out what contingencies they were willing to waive and which ones were most important to them. And I think that is especially important right now. I mean, obviously a lot of the competition when you're, having competing bids is based on the price. But it's not just based on the price. Perhaps the buyer wants, more time to stay in the home post sale so that they can, figure out where they're going to move to, the seller, I should say. Perhaps
Sure.
perhaps they, don't want to have tons of people coming in and out of their home. So they're going to be more specific about what they're willing to have for a home inspection. There are different things that people are going to look out for, and also what's, prevailing in different markets varies quite a bit. In some markets, you won't see those sorts of features in the offers that are made, whereas that's, pretty common in more popular markets. So those are all things to consider in addition to, what your budget can handle.
Does waiving the appraisal, I mean, that just struck me as something that I don't know if that makes sense to do that. I mean, obviously that would speed up the process, but doesn't that kind of really take away your ability to value the home and also maybe even, consider things that you might want to improve or not improve?
Totally. I mean, I don't think it is necessarily the most advantageous contingency to waive.
Mm-hmm.
It's certainly, I can see why a seller would be interested in that, especially if you're in a market where lots of people are making all cash offers and you are coming in with a mortgage. You might, be in a tough spot there because those all cash offers, financing is not an issue. So, an appraisal falling through or something like that wouldn't be a risk for the all cash buyers. Whereas if you're buying with a mortgage, and let's say the mortgage lender, does decide, does take the appraisal and say, hey, the home's really not worth what they're asking, we're not going to finance that much. That could cause the sale to fall through. So I can recognize why a seller would want it, but just for the reasons you just laid out, there are significant risks to the buyer. I will say if you decide you need to go that route, say, that your market really requires it, and that's a local thing. First of all, you'd have to find a lender willing to do it. Certainly the mortgage, lender may not be okay with you waiving the appraisal. You would have to get approval. You can't just say, I'm not going to do an appraisal. But second of all, I would certainly in that situation be very, very deliberate about the home inspection. Obviously, those are two different parts of the process, and the appraisal doesn't uncover all the issues, and the home inspection does, and they are looking at different things to be sure. But if you're, already in a situation where you're not having an appraiser come to a home, you don't also want to not have a home inspector come to the home.
Yeah.
So that would be my, that would be my word of warning. But it's something you need to, there are certainly risks to that strategy.
Yeah, well, I guess proceed at your own risk. And I mean, that's what you're talking about when you have this balancing act of wanting to buy a home, needing a home, expanding your family, wanting more rooms, and doing it quickly and not taking the right steps. That could really hurt you in the long run. I think people really, really, really need to think that through. Jacob, we're going to leave it there. Really appreciate you coming on the program. Really interesting stuff. Good to see the markets moving, though, and glad that people are getting out there in some way, shape, or form to look at these homes. Have a great rest of the weekend. We'll talk to you very soon.
Talk soon. Take care.
Bye-bye.
Bye.
Welcome back. Now we're going to shift gears to learn what's going on Capitol Hill in the legislature and in the regulatory front. Joining me on the line are David Levine, Kevin Walsh. Both are principals with Groom Law, an employee benefits law firm based in Washington, D.C., and we refer to them as the Legal Eagles, named after the Robert Redford movie of the 80s. Gentlemen, what an intro I just gave you. Great to talk to you. Thanks so much for joining us this morning.
Thank you so much for having us, Jeff. And you know what really scares me? I had never put two and two together as to where Legal Eagles even came from. But as soon as you say that, I remember that movie. It's a pretty good one.
It was
I recommend everybody check it out on Netflix, Hulu, Amazon Prime, wherever it is this weekend, because, we're probably going to claim like a royalty on every time the word Legal Eagles is used. But putting that aside, I figured we should talk about something substantive. So, Kevin, what's top of mind this week?
Top of mind this week is something substantive. Um,
Can we reformat the section? Go ahead. Please go ahead, Kevin.
so this week, what we want to talk about is there was a GAO report that came out that talked about planned cybersecurity.
Hey, Kevin, pause. What is GAO?
Well, why don't you give the answer to that? I think it's Government Accountability Office, but I could be wrong.
That's right. You're right on that.
Yeah, you're right, but some of our listeners may not really track this wonky stuff, so I thought I'd ask.
I've lived in DC long enough that I just use acronyms.
Okay, you're a SME. Keep going.
Okay, so it came out with recommendations on planned cybersecurity, and it flagged that cybersecurity is becoming an increasingly important topic in the retirement space because one, information and data is shared broadly with service providers and plan sponsors, and two, there's a lot of money there. And the old saying goes, why do you rob banks? That's where the money is. Like, why do people rob retirement accounts? That's where the money is. So the GAO came out and made really two big recommendations. The first recommendation they made was that the Employee Benefit Security Administration, or EBSA, if we want to use the inside the Beltway abbreviations.
Thank you, Kevin.
That EBSA come out with some guidance.
You see, Kevin got blurred out because of the inside the Beltway
and then the second recommendation, go inside Beltway. And then the second recommendation they made was that
someone's calling.
That the second recommendation was that EBSA provide clarity about what those guidelines should be. So provide baseline measures that plan fiduciaries should put in place. What's particularly interesting is that the agency responds to the GAO's report, and in their response, EBSA said, we think it's already clear that plan fiduciaries have an obligation to take cybersecurity into account. So from my vantage point, I think we kind of need to get some guidance on that in the not too distant future. But I'm also somewhat concerned that, this could be like missing participants, another area where, the Labor Department has just assumed there's responsibility, despite the fact that they previously haven't said anything. David, do you want to provide any commentary in addition to that?
Well, of course I want to provide you commentary, Kevin. And, it's funny, the quote about you go where the money is, it's the second time in 24 hours when I've been doing whether a podcast or yesterday it was a presentation where someone brought that up. It must be top of everybody's minds these days. But my kind of takeaway, let's try and spin this to what does it mean for everybody in the community for a bit? Because the GAO report, for those who haven't focused, it's an excellent starting point. For those who've been in this space, it's sort of, you pick it up and say, yeah, this sounds about right, what we've been hearing and thinking. And given the DOL is going to be putting something out soon on this, and we've seen it in investigation in Department of Labor, Employee Benefit Security Administration, notice I didn't say EBSA, investigations. But EBSA investigations have brought it up, all jokes aside. I think there's a couple things to keep in mind. First, we have some tensions in this area that are still being worked out. I happen to agree with a lot of what you're saying, Kevin. Actually, I agree with you completely. That I'm a little nervous as to see what the DOL comes out with sort of in its informal guidance, because there are ways that our system works, whether it's information flowing back and forth to employers, where they're trying to provide benefits to their employees and take good care of them. We're seeing a lot of discussion about COVID information, for instance, on the healthcare side. So to the idea that service providers, they need to be exchanging a lot of information to run their plans for their clients. Plus, when service providers are helping operate plans, they're also providing things like wellness. We've talked a lot about wellness and why it's important, and there's a lot of interest in that. And when you have wellness, who has the data, what's the security, how does all that work? That's a big deal. Then you get the DOL in investigations asking questions when there isn't even guidance yet. I understand and I respect that they're trying to protect people, but security cuts across many lines. It's not just ERISA in a bucket. So what do? As a plan sponsor, I would right now sort of be thinking, okay, what are my security procedures? And I can tell you, Kevin and I cross over, but there are some people who do, some people who don't. But sometimes you get the security people on one end and the ERISA people on the other, and sometimes they're speaking Greek to each other. So it's good to understand what is unique and how does your security work as it relates to your plan and your plan operations. Number two, it's how do you document this? What's your process for documenting it? Again, this is not your typical investments. It's a different skill set. So it's important to know how do you do it well. Number three, if you're a service provider, what's your structure? I can tell you a lot of record keepers, for example, have insanely robust security measures built in. It's very impressive, actually, when you talk to their people and where they come from on their credentials, but actually what they do. But it's important to keep that in mind. Third, this is a great opportunity for a dialogue between service providers and plan fiduciaries and sponsors to say, do we think there could be gaps we can improve on? It's an evolving landscape, so it's always changing. But are there things we can work together on to minimize exposure if we learn that there's something happening? I always say whack-a-mole, but that's the reality. The last thing I will mention, and because no Legal Eagle segment would be bad, would be good or bad without a discussion of missing participants, there is actually some tension out there. Because even the DOL's own guidance on missing participants that they put out, that's informal, non-binding guidance, but yet part of enforcement, they put out in January, talks about posting lists of people with benefits. When we're talking, how do those two reconcile, I think is a challenge. Because one of the ways that fraud happens is by telling people, hey, Jeff Snyder has a balance in this account, in this plan, and putting it up. I'm not saying people are inherently going to try to steal accounts, but you're actually making it easier by posting things and doing those things. So to me, I think there needs to be a lot of work on harmonization. So I talked a lot, but hopefully that's helpful.
So
Kevin.
David,
Yeah.
would it be fair to say, you should keep tabs on what your service providers are doing with data? You should evaluate what formats you're using for security, and then ultimately what really matters is how you space access to participant data and benefits once people have made requests?
Yeah, I actually do think, and Kevin, your use of formatting terms, it is very precise, because the spacing between a service provider and it's almost like putting in two columns in a chart. You need to make sure it's clearly formatted as to who owns what, when, and where. But Jeff, I think we're turning into grammarians, so I think we're done.
Yeah, well, let me just ask you a question real quick, gentlemen, because you both of you had testified in some of the, I think about California's CCPA or CPPA, whatever. I always get it wrong. You'll correct me. There are things going on in New York and some of these other states. How do you talk about harmonization, David? There's certainly the federal level, which you're talking about, or you and Kevin are talking about. But what about what's going on at the state level? Because California, New York, other states are coming up with legislation and ways to prevent fraud and rules, and coming up with regulatory rules around this as well.
Kevin, sorry, Jeff, that is a great question. I suggest we talk about it on next week's segment.
Oh, he punted it. Well, gentlemen, I want to go ahead.
No, we've just burned so much of your podcast. We got to end now. Okay. But yeah, we can talk all about it. Absolutely.
All right. Well, gentlemen, I want to thank you so much for joining us. Enjoy the rest of your weekend, and we look forward to chatting with you both next week. Enjoy. Bye-bye.
Yeah.
Well, that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our newsletter, The Morning Pulse, and of course, our website. We're back again tomorrow. I'll be joined on BRN AM by Shane Grimm. He is Director of Planning for the City of Havre de Grace, Maryland. You're going to want to hear this interview. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.